Hello and welcome to NAB's Property Insight webinar for Western Australia, South Australia and Northern Territory. My name is Courtney Worrell, Specialised Banking Executive for NAB in Western Australia. Before we begin, I'd like to acknowledge the traditional owners of the country in which we meet today. I would like to acknowledge the Whadjuk Noongar people as traditional custodians on the land of which I stand. I'd like to acknowledge all elders past, present, as well as the future leaders who continue their role as proud custodians of the country they belong to. I'd also like to acknowledge our Indigenous customers and colleagues who join us today. I'm thrilled that each of you have chosen to spend an hour with us. Speaking from Perth today, I can confidently say that there is an article every single day in the West Australian newspaper around the housing crisis we are facing. Coupling that with continued global uncertainty in the Middle East, in Eastern Europe, and with the US elections later on this year, it is really timely for us to hear from two of NAB's experts. We are joined by Mark Browning and Gareth Spence to cover what is being seen across WA, SA and the NT property markets, but also a general outlook for the economy, including interest rates, the current rental market, impact on rent roll multiples, and the state of commercial property market, including residential construction. To formally introduce our speakers, we've got Mark Browning coming up second today. He's the Head of Valuations for NAB and has been so for the last 6 years. His responsibilities include residential, commercial and rural valuations, as well as business valuations, panel management operations, valuation risk and reliability. As a career banker of 25 years, Mark's prior leadership has been in the corporate and business bank, credit risk, operational and product functions, and he holds an executive MBA. Gareth Spence is a senior economist, Australian economics for NAB. In his current role, Gareth provides detailed analysis of the Australian economy and advice on economic developments, both internally to NAB and externally to our customers, the media, and many other organisations. The Group Economics team at NAB provides a comprehensive set of domestic and international forecasts on a regular basis. A core part of his role is the responsibility for the well-regarded NAB business surveys, and which have become a trusted source of information for frequent and detailed information on conditions in the business sector. Gareth joined NAB in early 2018 after 10 years with the Reserve Bank of Australia, where he worked as an economic analyst and in the risk management and domestic financial markets departments. He has had coverage in those roles of the labour markets, wages, inflation, the household sector, business investment, and broad coverage of the Chinese economy, which is very relevant for those of us in the southern states. During his time in these teams, he worked part of a team which conducted the daily market operations as well as analysis of the short-term money markets, where he gained a detailed knowledge of the technical side of monetary policy implementation. You'll have the opportunity throughout the session today to ask any questions through the Q&A functionality at the bottom of your screen. Please ask away and I'll facilitate this session towards the end of the presentation today. Gareth, I'll hand over you to get us started.
Thanks, Courtney. I'll just bring up my slides. All right. Thank you for dialing in, everyone, today. I think, as Courtney highlighted, I'll probably take the role of the high-level outlook and happy to field any questions at the end of the session. And please do pop them in the chat as we go. We can have a bit of a think about them to get you the best answers we can. But I think for me, from a high level for the economy, and we kind of touched on some of these themes 6 months ago when we did this same seminar. I think the real big issues for 2024 are going to be what happens to global growth rates and inflation. Yes, that's pretty broad, but I think, we've had this very big monetary policy and fiscal shock over the last couple of years. Geopolitical risks are clearly elevated at this point. And so, there are some growing risks there, even though many of the pandemic factors have kind of faded well into the rearview mirror at this point. For Australia, which is my kind of bread and butter, I think, the story is pretty much the same as the globe. The questions we have are, like everywhere, inflation is moderated, but what does it take and how much longer does it take for it to kind of get back to target so that the central banks can start easing rates? What that means is, basically we think that there'll be a bit of a slow start to growth this year, but the second half of the year are a bit more optimistic. Things will turn around and start to kind of pick up a bit into 2025. And lastly, obviously topical and very relevant for this seminar, and I think for me feeds into, almost all the dynamics above, is really what's going on in the housing market. And so I'll leave Mark to talk to the details with you, but I'll cast some sort of some highlights at the high level as well. So just touching on the globe briefly to kind of show you the progression. I actually showed this 6 months ago. We've obviously had a bit more data and it is encouraging. So inflation has now moderated quite sharply or quite clearly from its peaks of 8, 9, 10% across the advanced economies down to somewhere around 3 to 5%. That is good. We've brought inflation down in a relatively short time, but just to note that it generally does remain a little bit above where central banks and each advanced economy's kind of inflation target is. So, good news that as lots of those pandemic factors have waned, inflation has eased. Now we're at kind of the point trying to think about quite a lot what does it take and how do we get there. The flip side, or kind of the mirror of that, is maybe also that we quite clearly think rates have peaked across most countries now. They've tracked sideways for 3-6 months across most economies. Switzerland and Japan are probably the real standouts, but just so different. So Switzerland's already cut once, Japan's actually hiking, but a very set of different conditions. What we think is ultimately, we'll see places like Canada, the United Kingdom, the ECB cutting around the middle of the year. Q3, we expect the Fed in the United States to start easing, and then Australia and New Zealand to start cutting rates around November. We'll touch a bit more on that later. Again, alongside this, this rapid rise in rates is that growth has certainly slowed. It's quite slow in most of the advanced economies, but we've avoided major recessions to date, and I guess that's reflected mostly in what we've seen for the labor markets across those countries. So unemployment has definitely drifted up. It's kind of well off its lows of, let's say, around the low 3% range in most countries. And it has ticked up, but it is still quite low and often a bit below where it was pre-pandemic. So to date, certainly an adjustment going on, but maybe not as painful or as worrisome as we went into this with inflation so high. So turning to Australia, pretty much the same story. I guess this graph just shows us total GDP growth, and I like to split it by kind of consumption and then everything else that contributes to our economy. And I think, consumption's around 60%. We'll talk about some of the dynamics behind consumption, but it is therefore pretty important for where growth goes. And you can kind of see here that a couple of things is that consumption growth, so the red bars, kind of really slowed in the back end or the second half of 2023. Spending was up just 0.1% over the year. Something more normal is around 2%. And so kind of the big driver of the slowing in growth. You can see there the other bars have actually kind of held up, so actually supported the economy despite that slowing in private consumption. And what that's really due to is, the spending we've seen on the fiscal front from government, state and federal. We've seen some parts of business investment kind of keep increasing, and we've also seen a recovery in trade. The flip side of that, and something we'll touch on a bit today, is really the drag for the economy, despite the strong growth we'll talk about in population, is really that housing construction has been quite weak, and even those elements of business investment where pandemic-related stimulus like the instant asset write-off or the accelerated instant asset write-off have worn off. But the other thing just to call out on this chart before we move on is, we think we're near the trough in growth. So we don't think we're going to see a recession defined as 2 negative quarters or anything. We think growth will be pretty soft and below trend this year, but still positive. And from around the middle of the year, things will start to kind of pick up again. So that data is a little bit is to the end of 2023. How have we been tracking in early 2024 with almost more than a full quarter now past? We can look at our monthly business survey. So each month we go out and we ask businesses as part of the NAB business survey, what is your trading? What is your profitability? And what are your employment levels like? And you can see here that through 2023, it certainly slowed alongside that slowing in growth, but maybe somewhat encouraging is the resilience we've seen in early 2024. So still tracking above average, certainly eased from where it was, but not falling much further and actually above average. So speaking to a bit of that resilience in the economy. So one thing the survey does tell us is confidence is quite weak. There's plenty of gloomy and negative headlines globally and fears over, the impact of rates domestically as well. But capacity utilization is still quite high. CapEx intentions are still positive. Employment intentions are still positive. So somewhat resilient heading into early 2024. Switching back to kind of the key dynamic we think or we're watching in terms of consumption this year, and that will drive overall growth, is really the pressures on household income and household budgets. So I showed you this graph last time, and we've got a few new data points since then, but really the focus here is that black line there, which is disposable income, which is after the impact of interest, tax, and adjusted for the impact of price rises. So it's in, kind of purchasing power terms. And you can see that, that fell for 5-6 quarters in annual terms. It fell by quite a bit. That's very unusual. And certainly is, explains a lot of the pressure on households where we know per capita spending has actually fallen a little bit. And again, that is quite unusual in a sustained sense. So you can see there just the sheer impact that the rise in prices did as a drag on incomes. You can see that as we had some nominal wage growth, the income tax burden, which is now around 20% of gross income, kind of dragged, and also interest payable certainly weighed. But offsetting a bit of that is actually just the strength in labour income. So we'll mention later, but the labour market has been quite strong. Employment's continued to rise. Wage growth has picked up. And hours worked has also picked up. So offsetting some of that weakness. And what we saw in the last quarter of last year was really that kind of flipped. So the drags have faded and kind of income in real terms is now positive again. And so that will be a key dynamic. Maybe it's happened a little bit more quickly than we thought, but as we progress later in the year, we'll get potentially interest rate cuts. Inflation will keep moderating, and we'll also get those tax cuts, which have been now locked in, and that will kind of really seek to boost disposable income and then flow through to consumption. How have households fared over all of this? Well, again, consumer stress from our NAB consumer sentiment survey has certainly risen and is quite high. But again, in Q1 this year, that actually ticked down for the first time in 6 quarters. So kind of as those income pressures are easing, we're actually seeing it already in survey measures. What it does show, however, is that, whilst overall consumer stress ticked down, cost of living stress is still quite high. 1 in 3 still report very high levels of cost of living stress. And I guess from this graph, all I really want to point out is, it's the unemployed, renters, and also the younger or lower income earners, which kind of really face into these pressures and point to the cost of inflation, I guess, more broadly. So, kind of watching that as we progress. You've got 2 ways to kind of split this, but basically, in aggregate, we certainly have seen discretionary spending decline over 2023. Essential spending has held up a little bit more as those pressures kind of weigh on households and they have to make sort of more conscious decisions on spending and how they go about it. You can see from our consumer sentiment survey on the top left up there that really the cutbacks are coming through the discretionary items, right? So around 57% of respondents report cutting back or changing their patterns around eating out at restaurants, buying micro treats, entertainment, and even car journeys with the petrol price. That contrasts quite a bit with the bottom right hand of this page, just to say that, maybe some of these are considered a little bit more essential and prioritized. So, private school fees or school fees, children's activities, pets, home services, and even insurances are kind of well down on that scale of pullbacks. The flip side again is obviously households have adjusted on the spending side to a degree with those pressures. They've also reduced their level of savings. That had declined quite sharply to its lowest level since pre-GFC. But again, in the last quarter, it kind of looks like it's stabilized a little bit, right? So maybe some of that pressure coming off households. They're still adjusting, but adjusting both sides of the equation, pulling back a little bit on spending, but also saving kind of a bit less. I guess importantly, it is still positive, and there is a distribution of this. So, as we sort of highlighted in the consumer survey, there are certainly groups who are facing into greater challenges, but as a whole, the household sector looks relatively okay to date. Flipping, I guess, to the sort of key point of today, and I'll let Mark take you through much of the detail in prices and rents, but just to highlight, alongside this pressure on households, as we discussed last time and has continued since then, is just that despite that very rapid increase in interest rates and reduction in borrowing power, actually house prices have been extremely resilient. In fact, just continue to rise at a bit of a solid rate across the capitals on average, and certainly stronger in WA and SA than others. So, a little bit surprising, but just reflecting the sheer demand in the housing market. The rental market is still exceptionally tight, particularly in WA and SA. And obviously rents are growing very strongly there as a result as well. So to kind of put this in pictures, what's really driving that demand, this has become a little bit clearer over recent months as well. Australia-wide population growth has accelerated to 2.8%, which is very strong historically and the strongest since 2008. The big driver of that has been the rebound in overseas migration, around 550,000 migrants Australia-wide over the year to September, and on top of that, some natural increase, so taking total population growth to around 650,000 for the year. You can see here that for WA and South Australia, certainly a similar story in the sense that overseas migration has been a very, very strong contributor. Like most states, there's a few swing factors going on, but for WA, kind of a bit of a flip in a trend on interstate migration. So maybe some outflows, although declining in the lead up to the pandemic, but actually seeing net inflows, through the pandemic and still continuing right up till September last year from in other states. And I guess that's seen population growth rise, to 3.7% on that working age measure down the bottom, which is just simply very strong. Similar for South Australia, maybe a little bit different, but usually a state that does see some outflows in an interstate sense, which weighs on population growth. It looks to have run its course and things to be normalizing a little bit now, but certainly has boosted population growth over the last year, and very strong historically again at 1.92% on that measure. For the NT, our colleagues and customers up there would not be surprised at this, but maybe a little bit more cyclical than most of the other states, depending on what's going on in the labour market and other things. You can see here that growth is actually sort of slowed a little bit more recently, and really the key story there is, there has been a rebound in overseas migration, but the outflows to other states have accelerated a little. So maybe a slightly different trend there on the demand side. On the supply side of housing, which is really the big story, and this comes up quite a lot, is, very strong population growth, very strong demand growth, but obviously we haven't met that on supply. You can see here, we showed this last time, but dwelling completions are still tracking at around 170,000 annually. On headline population growth, we need something more like 240,000, so quite a gap. And it doesn't look like we're going to get that close to it. You can see that the bottom left-hand panel there, some different trends. The NT, obviously a bit more cyclical, is actually quite low in new housing supply. Adelaide South Australia is about where it normally is. But interestingly for WA, picking up for the first time in a while. Obviously a very different cycle over the last decade with the mining boom and inflows and outflows, and a bit of a normalization in housing supply post the peak. But again, for the first time in a while, is actually picking up now. And you can see that on the right-hand side, it's just to say completions are generally low across the country, but the pipeline's actually quite high. So there is a bit of a bit of a tension there as to why we're seeing, so many new sort of dwellings completed. Something we're looking at quite closely and is coming, through a few different angles is really that, despite that recovery in supply chains, even a little bit in labor supply, the cost of construction still remains quite high. So inflation has certainly slowed, peaked at around 17% on housing input costs. It's back to around 5%, which is a little bit too strong, but it's certainly slower than where it was. But the real story there is that top left. So despite that slowing, prices actually do remain around 30% above where they were. And again, on the right-hand side, it comes through in a survey sense from our residential property survey where, around 3/4 of respondents tell us construction costs are a barrier to new developments. But you can also see there that labour availability and even delays in obtaining permits and planning are kind of things that are weighing on actually getting new dwellings out there. So what does that all mean? A few things, but I think nicely summarized as we did last time is that, generally this has led to kind of a big reduction in affordability. Prices have risen quite strongly, but so have interest rates. Sometimes or normally we'd think they'd go the other way. And that's led to, increasing amounts of income spent on housing. You can see here, for Australia wide, that's sort of its lowest level in around 30 years. What this measure actually is the proportion of households in each state or across Australia. Sorry, the proportion of dwellings that can be purchased, across Australia using 25% of gross income of the average household. So sort of weakened everywhere. You can compare them in a relative sense. So the lower it is, the less affordable. You can see that WA and NT for now are, at least despite that sort of weakening, actually still a little bit more affordable than the national average, but South Australia is a little bit more close to that. Turning to the labour market, so as I said, growth has slowed quite significantly, although the level of activity is still quite high in the economy. And the labour market has held up kind of relatively well as it has globally. So you can see that across most states, it's actually ticked up, but it does remain quite low. And despite, very strong employment growth, we're now at 1.3 million people across the country since the start of the pandemic. Vacancies actually still remain elevated. So still 60% up on pre-pandemic levels. The vacancy rate is quite high, around 2.6% of the labour force, despite easing over the last 3 quarters. And still quite a relatively high number of vacancies for each unemployed worker. So, despite that slowing in growth, the labour market has remained quite resilient and even a little bit tight, which is feeding through to wage growth. That across the country has accelerated. It's accelerated across all industries. You can see that at around 4.2%, it is its strongest in quite some time, and the strongest it has been in education, training, and health. 2 industries that I guess kind of saw a bit of an additional boost from the minimum and award wage increases we saw last year. So another factor, but something that will be quite important eventually for where inflation settles. And you can see here just headline inflation on our monthly and quarterly measures for Australia. Certainly have eased, have matched that kind of global pattern. We've gone from around 8% in late 22 to, 4 or 3.5% in early 2024, which is a pretty solid easing, but a little bit above the RBA's target. And really what's driven sort of that easing or disinflation to date has been on the good side. So as, global supply chains have normalized, freight costs have eased, global demand has slowed and price pressures have eased. Goods prices in some categories has actually fallen. We've seen some discounting, but at least the rate of inflation slowing. Things like things like the services sector, probably a little bit more challenging. Things like insurance tracking at above 16% for now. Postal services, restaurant meals, haircuts are all tracking kind of well above where they were pre-pandemic. And that's sort of the questions we have going forward is, how does that resolve and how quickly do they kind of fall? So we tend to think of this as economists in goods versus services, or trade exposed versus not trade exposed. And it's certainly true the RBA targets headline inflation. But when we're really looking at where we end, right, we know lots of big global factors are unwinding and there's a few shocks playing out. What we're trying to decide is where does inflation land as those things kind of wane. And it's obviously kind of a bigger assessment about what is the domestic or the true domestic pressure, right? So typically things like services with a larger wage component. And you can see here that typically the trade exposed kind of categories in the CPI basket certainly have eased. Home building contributed a lot on the way up, and it has eased quite sharply, but does remain high. But kind of the less trade exposed, so typically services, some of the things I mentioned before, do sort of remain high. So watching how that sort of plays out going forward, it will be quite important. We think wage growth will slow and wage pressures will ease, but actually there's a bit of a broader story going on. We know that typically lots of these services type firms, have faced large insurance costs or large insurance pressures themselves, higher energy bills, higher utility bills, and even commercial rents. So things we think reflect lagging sort of pressures might eventually ease and give us sort of some comfort that we think inflation, will continue to moderate, at least for now. So for the RBA, what does that mean? Well, we think we're clearly at the peak. We think they'll be on hold until November, and then they'll start to cut back fairly gradually, but by around 125 basis points over 2025, getting us back to 3.1% by early 26. And really, what allows them to start cutting will be the confidence that, you can see inflation is going to sustainably return kind of back to target, back to 2.5, within a reasonable time frame, while managing those risks that they don't let inflation stay too high for too long, which you've kind of seen earlier on, just how detrimental that is to the economy. I guess more broadly, how does that play out? Just to recap, well, we think growth is approaching its low point. We think it will accelerate in the second half with, consumption rebounding, hopefully business investment remaining positive, and maybe some turning in dwelling construction. Unemployment will rise, but I think importantly, employment keeps growing, right? So with strong population growth and a slowing in labour demand, unemployment does drift up, but it generally remains below where it was pre-pandemic. And I guess ultimately for now, we think inflation will continue to ease. It might be a little bit bumpy. We've certainly seen things like the US over the last week where growth has remained quite resilient. Labor force or unemployment rate actually ticked down, and inflation has accelerated over the last 3 months. And the real thoughts there are now higher for longer. So certainly highlights the risk that this disinflation process can be bumpy. But we think by the end of the year, we'll be close to something like 3% at the top end of the RBA's target band. And by the end of next year, somewhere, closer to the middle or the top half of the RBA's target band. So I might leave it there and hand it over to Mark to take you through some of the details on the property markets more specifically.
Fantastic, Gareth. Thank you for that, and great to have the opportunity to join you again. So just to give you a sense as to what we'll work through today, we'll go state by state and cover initially the metro property market. We'll then talk through the regions of that respective state. Also talk through commercial, a glimpse through commercial, talk about the rent rolls, and then move our way through. So if it's not your particular state of interest, just bear with us till we get there. And keen to make it as engaging and give you as much information as possible. Now, we know how important property is to Australians' wealth, to you as business owners. And just, a recap, since we were here around 6 months ago, the value of Australian housing now at $10.3 trillion. It's up $0.2 trillion in that period of time. And certainly the peak rises that have been occurring in Perth and Adelaide and WA and SA more broadly, in particular, have been large contributors to that rate of growth. And you can see how other assets fit in as part of that. To set the scene across the capital city markets, you can see each of the main capitals here, and quarterly growth, annual growth for houses and units highlighted there for Adelaide, Perth, and Darwin, reflecting, as Gareth's already remarked, strong growth in Perth and in Adelaide, and more muted growth and consolidation occurring in Darwin as a result. And we'll unpack each of those as for you in a little bit more detail. If we look specifically at the last quarter, so the first quarter of 2024, you can see there for capital city growth for the first quarter, we've got Perth up 5.6, Adelaide up 3.3, and Darwin up 0.4. And then respectively, the regional WA up 4.6, so just a little under the Perth comparison, but still growing very rapidly. Regional SA up 3.3, so on track with the capital city, and also just looking north to rest of the territory, tracking up 0.4 again in line with the capital city average. You can see there how both regional markets and the capital cities have tracked over the last 10 years on an annualized, on a consolidated basis. If we turn now to the segments of the market that is moving, what we've highlighted here is the red bar is the most affordable quartile of the market. The black bar is the most expensive. And the growth in Perth and in Adelaide has definitely been driven out of the most affordable quartile. You can see growth in Perth up there, up by 7.4 and 4.5% respectively in Adelaide, whereas the most expensive quartile of market track at a lower level in both those capitals. In Darwin, it's the inverse. It's in fact the most expensive quartile of the market that has experienced the most growth, and the most affordable quartile experiencing some softer conditions overall in that particular market. If we turn to sales activity, you can see here for annualized, so this is to March for the year compared to the year prior. You can see growth, Perth there at 6.2, Adelaide 6.8, and Darwin just tracking a little bit of easing conditions compared to the 12 months prior. And certainly, both regional WA up 7.7 and regional SA up 1.6, showing positive growth, whereas regional Northern Territory is showing softer conditions. And again, the last 5-year average here showing both monthly sales volumes as well as a 6-month moving average to give you a sense as to how sales activity has been tracking over that period as well. If we go specifically to Perth, let's start in Perth. We can see Perth market continuing to grow really strongly. It's been the standout nationally. We saw softer conditions in the East Coast as interest rates increased. That didn't occur in Perth, and growth has continued. It's up another 1.9% last month, up 5.6% for the quarter, and up 19.8% over the last 12 months. So that sees Perth up 56% than prior to the pandemic. So that's over the last 4 years now, and reflecting the strong growth in residential property in the Perth market. Listings are off on the same time last year, really challenging to get listings, and I'm sure that'll be a feature of comments and questions today. Really tough, and that transpires to average time on market down to 11 days, and really hard to get the board up or get the listing out on your emails and the property's already sold. So challenging for agents, challenging for purchasers as well. So that's off from 17 days this time last year. And Perth's rents are continuing to grow at a healthy clip as well. Houses up 13.7, units up 15.9, and record level low vacancy rates as well. So again, the challenge to locate properties both to buy and to rent really persists in Perth, and continues to be one of the local challenges right across Perth. If we look at how the market, for a visual, how a graphic representation of the market, the bluer the colour, the deeper the blue, the faster the rate of the growth. This reflects the first quarter of 2024. Not too many pockets of lighter apricot-y, orangey coloured, which really is the market that's more tracked sideways or any easing. So you can see strong rate of growth, bluish right across the market. If you're used to seeing that more in a tabular format, here's the SA4 regions that make up the Perth market. You'll see a quarterly growth there, middle of the page, reflecting the southwest at 6.5% growth, and Mandurah and northwest really strong quarterly rates of growth that's occurring, albeit relative to East Coast. It's all very strong levels of growth. If we think through the pockets that are showing the greatest growth from a rental value, they're in the northeast and southeast, up 21.1 and 20.8% respectively. Average selling days, the northwest is selling quickest at 10 days, the longest, the inner markets taking 19 days currently. And then for an activity sense, compared to 12 months prior, showing an increase of 7.4% of increased sales compared to the southeast, off 1.8%. If we bring that to life further, you'll see how we've tracked sales there on both last year, but looking at compared to the 5-year average. So no surprise there, a much more active market than it was over the longer term average, albeit listings on 12 months ago, obviously more challenging to obtain, albeit relatively in line with the 5-year average across Perth more broadly. If we think go to the regional parts of WA, that same fast rate of growth is still evident there. Regional WA is up 56.2% on pre-pandemic periods. The rate of growth has continued in March, the month of March, as well as for the quarter. So the quarterly growth up 4.6%. Bunbury and the Outback is showing strong rates of growth there. You can see on the tabular, Outback South, is showing strong rates of growth. On rental values, it's been strongest in Bunbury, up 17.9%, and then also Outback South again at 14.6. Selling days, quickest in Bunbury as well, 19 days, and Outback North taking 46. And you'll see there that activity levels from a sales activity is softer than the same time last year, and a couple of examples called out for you on the page. But if I take you to this, to wrap up WA and take you to the commercial insights. Look, I think the commercial market, the key asset location, the key asset types in this location are all continuing to reflect the broader national trends of adjustment to higher interest rates. It is absolutely fair to say, the office vacancy rates in Perth, for example, have not fared anywhere near as badly as the East Coast. In fact, vacancy rates have dropped in Perth, and sublease vacancy is also much lower than some of the East Coast peers. Whilst there continues to be a flight to quality more broadly in office space, there continues to be a theme of occupiers considering their demand and their need for office space more broadly. The adjustment that's going through office is really accommodating some time work from home, the flight to quality to higher quality buildings, end of trip, cafes, and higher green ESG and green rated buildings, neighbours ratings and the like. So they're all some of the themes that are reflected in the office space. We know Perth is a key capital for lots of key mining and other national tenants as well. So largely a key driver that's in that space that's evident, albeit no major transactions occurring in the first quarter, and more broadly across the country, still a challenge to get a full read on the market, given that adjustment that's going through the office space more broadly. In retail, the retail space was already going through a series of adjustments prior to COVID even starting, and largely is most advanced, having undertaken the reset. Face rents are growing. There's some adjustments and emerging level of some sales starting to emerge. Less large institutional or REITs that are buying. It's mainly the privateers and large family offices, etc., that are buying some of these centres at the moment. And you'll see there, look, a couple of the levels of activity and how Perth is tracking on a rate per square metre compared to the some of the other capitals, just by way of interest. If we move to the left-hand side of the screen, talk about industrial. Look, it was an asset class that adjusted and got to a really fine level of yield, perhaps overly sharp compared to its longer-term average. Largely two markets have now emerged in industrial. First of all, the investment style of market, and that's still got only limited transactions, but the yields have softened, decompressed in that space. Still, rates less growth has occurred, largely has offset some of those softening yields. At the lower end of the market, however, a number of owner-occupiers are buying their own property and controlling that future for themselves. And they're doing so largely because they've seen rents increase. They're looking at the longer-term ability to control where they are at. And so we've seen perhaps two tiers emerging there. Quite values have held up quite well in the lower end of the market as owner-occupiers have sought to purchase themselves, whereas the investment is understandably showing the yield adjustment that more broadly occurs across the space as interest rates have risen, including those longer-term rates that we heard about earlier. We move now to rent rolls and some of the key drivers and influences here. I've just tried to put those in a snapshot on a page for you. Largely some stabilisation in that space, and still a healthy demand for rent rolls. Lots of with the growing rents and low levels of vacancy, then there's lots of opportunities that's contributed and driven values more broadly. The challenge continues to be the attrition of properties as they're taken out of the pool and sold. And whilst we're aware of lots of East Coast investment activities and construction that's occurring, the challenge becomes making sure they are completed and then go into the pool for availability, and that transactions are still flowing through the pipeline largely across the board. So strong demand, and just a couple of insights to bring that to life for you. We'd go to Adelaide. I'm mindful of trying to allow some time for questions. You'll see the Adelaide market also is experiencing strong rate of growth, up 57.1% on pre-pandemic levels, continuing to grow in the month of March and for the March quarter, and up 13.3% on the year. Listings are down on the same time last year. Sales are up, and time on market or days on market has tightened into 32 days, tightened by five days compared to this time last year. Rents are continuing to be strong in Adelaide as well. Very similar. They're up for 9.2% for houses and 9.5% for units more broadly. If we think through the geographic locations, again, you'll see the graphic here represents the last 3 months and what's been occurring. The highlight, the location has experienced a stronger level of growth. Apricot-y and orange colours are more representing easy in the market. Go to the tabular format of that, you'll see Adelaide North, Adelaide West, strongest, and South all up 3.3, pretty even across the board there, with only Central and Hills just slightly off the same level of growth. So a broad spread of price growth across the Adelaide market. On rental value growth, it's Adelaide West up 14.6, that's leading the charge there. From selling days, the North 28 days, Central and Hills up to 37, and from an activity sense, Adelaide West up 10.7% compared to the same time last year. This just gives you that same style of information on a table, in a graphic, sorry, and draw your attention on the right-hand side there to sales compared to 12 months ago and the 5-year average. So up on both, reflecting a higher rate of activity in the Adelaide market compared to the longer-term average. In contrast, the challenge to get listings significantly down on both last year and 3% off the 5-year average in Adelaide makes that a challenge for agents and for those that are looking to purchase to have options to do so, leading to the price growth that we've been talking about earlier. If we go to the regions, regional SA is up 56.2% since before the pandemic, so over the last 4 years. Continues to experience growth, up 1.1% in March and 3.3% for the quarter. Barossa, York, and the southeast, the strongest areas. Barossa, York up 4.3%, which is strong growth in regional markets. Rental growth, southeast up 14.3%. Again, really strong levels of rental demand and selling days. Southeast again leading the charge there at 45 days as well. We turn, and some of the same remarks on commercial would apply in SA, albeit we know there's a number of new precincts that are coming to life in SA, in Adelaide, but more specifically, and it's good to see a number of new buildings also from an office point of view starting to occur after a number of years of more challenging conditions to bring new office supply to market in Adelaide, albeit we certainly acknowledge the backfill challenge for that and the range of secondary stock that occurs as a result of that. Reflecting there the vacancy rate conditions on the right-hand side of the page. Broadly, similar comments that I make earlier on industrial and retail also apply in and across Adelaide. Again, on rent rolls, just some brief insights and multiple updates there that we trust is of assistance. Ongoing challenges of securing the right staff to manage the rent rolls and manage the arrears, and the competition for that is challenging, and we know that's in a number of instances pushed up the costs of managing that as part of that, which we call out on the far right hand side. If we move now to Darwin, really important to still include Darwin. Conditions, as I mentioned earlier, have more tracked sideways in Darwin, not the same level of strength of growth as is evident in Perth and or WA and SA. Darwin has now risen for the quarter, but just softer conditions for the month. But he's up 24.4% than prior to the pandemic, so that's still a healthy level of growth in that market. You'll see there, average days on market has lengthened and a little bit more discounting prevalent. Listings also down, and sales activity has eased on the same period last year as well. Again, here's the graphic for in and around the market, just to bring that to life, and then to give you that sense across the two SA4s. Again, as I mentioned earlier, both Darwin itself and the region has tracked a similar growth for the quarter at 0.4%, and the broader context of rental value growth up 5.5% in Darwin, and tracked at an easier rate at 1% in the regional location more broadly. Courtney, with that, I might hand back to you for questions to make sure that we have time to answer from all those that are attended.
Thank you so much, Mark and Gareth. I have written so many notes today. First question from the chat, I think this one will be for Gareth. Questions around Australia's labour productivity, which has been zero or even negative recently. What's your view on this, and how do you think artificial intelligence will have an impact?
Thanks, Courtney. Yeah, big question, very important question. Look, it's been pretty weak in a measured sense. It's fallen over the last couple of years, sort of like that household income graph. It's actually turned around in the last 2 quarters, ticking up. I think, we have a few challenges. I think we actually released some research today, but, I wouldn't overemphasize the short-term moves in this. It's kind of what is our long-term productivity trend. And I think you're right on pointing to things to AI. We need to improve in some ways for wage growth to keep growing, right? To get some real wage gains, we need to see productivity kind of pick up from where it is. It's not all doom and gloom. We think the underlying trend is about 0.5%, not minus whatever it has been over the last little bit. On AI, I guess, personal view, it's hard to predict these things, but I think, there's always an adjustment period, and economists have this thing called the J curve, where you actually go backwards for a little bit first, and then it kind of picks up when we all figure out how to use these things. And, my experience here and in other places is that, people are thinking pretty hard about how to use it, and obviously it's got a big potential. So hopefully it is one of the many factors that, we're looking to hopefully boost productivity in the next couple of years at least.
Very much agree with the J curve. I know I'm trying to use Google's ChatGPT equivalent. I think it's called Gemini now, and I think it takes me longer to work out what the prompt is to ask it than to actually research it myself. But I can absolutely see the benefits and what that will do for our business in the coming years. We've got lots of people projected to come into WA and into Australia from a migration perspective. That coupled with still relatively high construction costs, out of control rents, and a very low supply of stock coming on the market. Really keen for your view, Mark and or Gareth, of where rents are going to go in the near and midterm.
Let Mark take it. Yep.
Is that the scientific reply, Courtney? Look, until supply is addressed, and I know, look, there is a number of investment properties, particularly lots of East Coast investors that might have gone north in the past, have looked to the west and even to Adelaide to some degree, and are putting a degree of investment properties and constructing those. That said, until they're complete, until they're on the market, until they're in the listing pool, there's not going to make a really a huge difference to supply and therefore to rent. So I see still rents being under pressure for growth particularly over the next couple of years, Courtney, until that supply response comes to market. And even then, it may not be enough to keep up with that levels of immigration that you need. And in the West, and to many regards, a similar comments apply for Adelaide as well, that are going there and relocating to continue to power those economies.
It dovetails into another question that's in the chat around will this real growth and how much will it spill over into the regional areas? And I know one of the numbers you referenced since COVID, the growth in regional property prices, say in Western Australia, was north of 50%. And I suppose it really ties in almost with that AI piece. The more people can work remotely and then move to these regional areas where you can still have similar job opportunities and work opportunities as you can in the metro areas, that's when we'll see continued growth in those areas.
Look, we will, Courtney, and great to work from Margaret River, or from a local surf beach down south, for example. The contrast with that, though, is we may well be pricing out a local who needs to actually have accommodation in that local town to be able to service and support the town, or work the hospital, or work, act as a barista to get your coffee. So there's trade-offs everywhere, kind of that flow through. So I agree with the premise of your question, though, that it creates more options now with work from anywhere or work from other locations, Courtney.
Yeah, and then I suppose what is, and I asked what is the answer? That's too big a question. I think the government and everyone's trying to work that out at the moment, but with the pressure on housing in all of the states, particularly the ones we've spoken about today, to the crux of it, where is everyone going to live? I know NAB released an article highlighting a South Australian customer where it was discussing tiny houses and the concept of that and how that can help ease the shortage. From your discussions around the country and, with that economic background, what are your thoughts on where we go from here?
I'll kick it.
It's a big one.
But I'll let Mark have correct me where I'm wrong. But I think, it is a challenge. It's a very serious challenge, right? Like these things like social housing have a huge, social and public housing actually have a huge role to play in where they should be. It is a challenge like Mark sort of raised, kind of pre-COVID, we were talking about shortages in regional areas on the East Coast and kind of the pressures there even before this work from home stuff. And it is important for a whole range of reasons. Mark would tell me you can't turn this around in 6, 12 or 18 months. And I think I agree. But to be honest, the hard answer is we do need supply. We need to increase the flexibility. It's a difficult challenge. So there's 3 levels of government and the coordination issues are quite large. It's not just build new houses and release land either. It's kind of about density. So, speaking to the points Mark made before, but, we need to build houses where there is infrastructure. There are benefits of being in cities when we want to talk about things like AI and productivity. Well, agglomeration benefits of living in cities is quite an important thing. So, it's a bit of a challenge and it's still there, and I might keep quiet and let Mark add anything to that, but it's probably the single biggest political challenge I think we're facing in the next little while.
Yeah, I definitely agree. I don't, in the same way as it didn't happen overnight, it's not going to be fixed overnight. There's not one silver bullet. We've got to try all of the above, whether it's rooftop, whether it's micro density housing, whether it's affordable housing, densifying near train stations and shopping centres, more apartments or units in Perth, which is not readily accepted yet, albeit with some early acceptance on the South Bank and perhaps out to near the casino. But it's not just one decision to be made, Courtney. It's a whole range of. We need to keep up the same level of intensity and focus around this in all range of governments and banks and the whole sector to enable a response. And perhaps Adelaide's maybe a little bit further advanced in some of that density piece that Gareth's mentioned, but still same types of challenges exist to make sure there is sufficient supply available. And it's pleasing that it's raised its consciousness across the economy, governments, business, and social sectors more broadly, but still not an easy one just to make one announcement and it's all fixed, unfortunately.
Yeah, absolutely. And as I said, it's very topical at NAB at the moment and across corporate Australia, as well as the non-for-profits. So it'll be really interesting to see how it progresses to, all of our clients and customers on the call today, within SME and mid-market Australia, the contribution that those businesses can provide to this really critical issue across our market. We are bang on close today. Thank you so much, Mark and Gareth. To our attendees, we are hoping to have the link to today's presentation emailed out to you by the end of this week. When you do close out today, you will receive a short survey, and we really encourage you to provide me feedback of what you'd like to see in the future. But thank you so much for attending and for your questions, and we hope to see you next time. Thank you.
Thanks all.